Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 28th of August. I'm Daniel Lam, your host for the podcast. As the Fed pivot approaches, we're hearing more clients asking about income solutions again. Well, this popular question has gone relatively quieter over the last 2.5 years since the Fed embarked upon its rate hiking cycle, but it has resurfaced again. Well, on the government bond space, we have been advocating investors to look for opportunities to lock in some reasonable yield levels, especially from the longer-dated bonds. It is always advisable to have a diversified allocation across different asset classes. Yields themselves are likely to be trending down as the Fed embarks and continues with its rate-cutting cycle. On the corporate bond space, the DM high-yield corporate bonds have outperformed their investment-grade corporate bonds counterpart since the start of this year, and that's helped by strong domestic economic growth and the prospects of Fed rate cuts. The key fundamentals, such as strong earnings growth and contained leverage, have also been significant. Now, these factors have improved the credit rating upgrade to downgrade ratio, which has been below 1 time since the second quarter of 2022. Looking ahead, the likely start of a Fed easing cycle should be supportive for DM high-yield bonds, as a lower yield environment would make it easier for high-yield bond issuers to refinance their liabilities. So this is supported by history and assume that the Fed is indeed successful in achieving a soft landing. So for example, in 1994 to 95, after hiking rates by 300 basis points over approximately 12 months, the Fed pivoted in June 1995 towards rate cuts and successfully achieved a soft landing. The average 3-month return for DM high-yield bonds over the subsequent 12 months was 4.1% versus 1.2% for DM IG corporate bonds. Now, incidentally, the fact that bond issuers would find it easier to refinance their liabilities also builds a case for smaller cap equities and for the less profitable companies. The main risk to monitor then would be the probability of a hard landing. Well, if the economy does get a hard landing, then the market would favor quality again. DM high-yield bonds or smaller cap equities are unlikely to perform as well in a scenario where the US economy ends up in a recession. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.